Our first guest today is Rob Collins. Rob is head of U.S. Private Wealth and a member of the Global Executive Board at Partners Group. Founded in 1996, Partners Group has $142 billion in AUM, and it's been a trailblazer in private equity evergreen registered funds. Rob has spent the majority of his career in alternatives, and for the past 19 years has been a leading contributor to the growth of the Partners Group's America's business. Welcome, Rob, and thanks for coming on the show.
Great to be here, Nick.
So let's start with a really basic question. What is a registered fund focused on private equity? How does it work and why does it exist?
Yeah, as the name says, they're registered with the SEC, typically the Investment Company Act of 1940 or the 33 Act. So they are, in essence, like mutual funds. You're able to get invested, stay invested efficiently. So 50,000 minimums or even 25,000 minimums, 1099s instead of delayed K1s, broad regulatory eligibility, sometimes accredited and qualified client, typically some liquidity mechanism, typically quarterly. So there are two basic categories: interval funds, tender offer funds, but they exist to provide access in a simple, efficient, effective way that didn't exist before with traditional drawdown funds. So that's what a registered fund is. An evergreen fund is what they're commonly known as. Sometimes people call them semi-liquid funds, but a simple, elegant, effective solution to get access to private capital.
So when you think about, like, private equity historically has only really been directly accessible to the qualified purchaser marketplace. So those are individuals with 5 million investable assets, excluding their primary residence. There's roughly 2 million QP households in the US out of 130 plus million. The registered funds allow the 12 million accredited investors who aren't QPs, and I think it's roughly a $24 trillion market, access directly into private equity. You don't have the complexities of a J curve, so no capital calls, distributions. Money goes in the ground. Day one is working for the investors. So Partners Group was a pioneer, probably the pioneer, in offering private equity through registered fund format. So talk a little bit about the history and how that occurred.
It's kind of a funny story, Nick. Really two catalysts. One was my dad. My dad used to work for the city of New York. He has a pension plan of the city of New York. And when I joined Partners Group, he said, "Rob, I want to have access to private equity because the private equity part of the pension plan has been the best performing part of the plan." And I said, "Dad, sorry, but these funds have a 10 million minimum. They have capital calls. They have delayed K1s. J curves, like this is not for you." But I knew there's that demand, from the individual investor. Around the same time, we had an RIA in Seattle called Filament, and they said, "Look, we understand alternatives. We invest in hedge funds. For some of our clients, we invest in private equity. But for many, we haven't been able to build that allocation to private equity because of the challenges with those traditional funds. We need something that is always available, that is fully invested, that is broadly available, easy, effective for us as advisors and our investors who are individual investors." 2009, we finally launched our fund. And we're able to do that because we're just built a little bit differently. So we had the right ingredients. We buy companies, we do co-investments with other managers, we do direct lending, secondaries, primaries, all in one firm. And then we had the right organizational setup to deliver this pro rata. So all of that investment content thoughtfully constructed. That's what we're all about at Partners Group, developing a solution.
And so your success has clearly inspired others. So if you look at the broad, sometimes they're referred to as gatekeepers, consultants, fund-to-fund players, but they really concentrate on secondaries and syndicated co-investments. Almost every one is now in the market with a 40 Act tender offer fund. I think there's maybe a couple exceptions. So the market has seen, just in the last few years, sometimes we refer to this as 2.0, the acceleration of just seeing these high quality products, typically delivering what one might refer to as more of an index play into private equity. So in some cases, very high quality private equity beta. Talk a little bit about the landscape today and what do you think sort of driving or propelling this growth?
Yeah, there's certainly been a product proliferation. So everyone's trying to develop solutions for the landscape, and there are differences. Every firm's different. in terms of their investment capabilities, in terms of how they're organized as firms. And some, to your point, much more diversified, maybe more passively built, taking what is available in the marketplace. Other strategies more concentrated, maybe more GP focused risk in those portfolios. So there are different approaches, many different ways to skin a cat.
To your point, we've seen some of the major private equity firms, and I think a lot of people maybe aren't aware of the fact that the SEC prohibits private equity firms, and there's 5,000 private equity firms globally, from creating and managing top to bottom their own registered fund. They require an independent advisor, and they do that to prevent self-dealing. But yet we've seen the big players, because these obviously, again, mature industry firms with, in some cases, hundreds of billions of dollars, one case approaching $1 trillion, but this is an important market to them, and they're not going to sit on the sidelines. So they figured out different ways of coming in. And in some cases, they're evergreen funds that might be restricted to qualified purchasers. In others, in the case of a KKR, they've done something very innovative with this kind of conglomerate, almost Berkshire Hathaway-like structure, where they are going to the accredited investor. So talk about the bigger players coming in and launching products, because one of the things that we've seen as the competition has really intensified, we've seen price compression, we've seen more institutional style fees in the marketplace, and education.
Sure, it's been a great thing to have more competition. I mean, you need competition to grow a market.
And one of the things that we're doing at iCapital is we're serving as the independent advisor. And that's really becoming an access point for some GPs who want to reach this marketplace, but can't do it on their own. So we have one fund, the iDirect Private Markets Fund, features KKR, Vista Equity Partners, and Warburg Pincus. So you've got sort of upper end of the middle market, you've got growth equity, upper end and sort of large cap deals, growth equity, and B2B enterprise software, which we think is kind of a trifecta. So we're seeing the market evolve. Talk a little bit about what it's going to take as we go from 1.0 into 2.0 to get more widespread adoption.
I think education gets to the single most important reason why this is a topic. And we get asked frequently, why are we talking about this? Why is this important? And the reason why it's important is because there has been this profound shift, public markets to private markets. More and more of the economy is found in private markets, private companies. The management teams that we work with, the entrepreneurs, they don't want to go public unless they have to. So there are these terrific companies with proverbial moats, as Mr. Munger and Mr. Buffett would write about, that are in the private markets, and you can't find them in the public markets. So this is why it's important, and this is part of the education piece, to explain to advisors and end investors why it's important to have a portion of the portfolio invested in this part of the equity market. So I think that education piece is critically important. I think iCapital's done an amazing job in enabling many of those conversations, informing that advisor to build that thoughtfully constructed portfolio of different funds. That needs to happen. So I think the industry needs to continue that journey in providing that education in order for these portfolios to be built correctly.
Well, thank you, Rob. Thank you for coming in, sharing your expertise, providing these insights. We greatly appreciate it.
Great to be here, Nick. Thank you.